Hello, David Moore, Equity Advantage, and I've got Robert Smith here from Peregrine Private Capital. And I got to admit, Bob, I'm sitting there getting dressed this morning, and I thought back on an old video we did, one of the early ones, and it was us, the two of us in these sort of loud, obnoxious shirts. So I said, okay, I figure Bob's going to be wearing a suit this morning, but I've got to wear this. I got to be me.
It's linen. It's lightweight, dude. It's summer suit.
It is. It really is. But I'm feeling a little bit. I've got this, and I should have. I didn't call you before we started this, so we're going to start off talking about bubbles. And bubbles, I always think like bubbles. A lot of times they're fun, right? A bubble you get to play with, the kids, all the bubble machines on the back of the bike and the parades. And we're talking about a super bubble, so you'd think that would be super fun. But we talk about bubbles in an economic context, and things are a little bit different. So would you care to explain to our audience out there today what a super bubble is in this context?
Well, we're borrowing very heavily from legendary investment guru Jeremy Grantham, who coined the term super bubble. And a super bubble, as specific to assets, is, a generational event, maybe once every 100 years, often described as a mania, tulip bowl mania, that kind of thing, where things become so terribly overvalued that when they finally do deflate, it can take years for an economy to work its way back to normal through the detritus or the fallout from that bubble. And he argues, and we take it to heart, that we are now in a super bubble because we have, by historical standards, the stock market is still very, very overvalued. The Buffett Index, which I believe takes, divides the stock market by valuation, stock market by the economy, historically has been valued from a valuation standpoint about 70% of the value of the economy, and it's still, even after the current correction, it's still over 200%. So it's more than double the historical mean. And the Case-Shiller Index on housing, which has historically been very accurate, very dependable, indicates that housing is now even more overvalued than it was in 2007. So normally when you have a single bubble, you have some place to run, some place to hide when that deflates. And now we believe that we have two bubbles, both in the equity market and in housing, that together makes up a super bubble. And when it deflates, it's going to be very, very hard to find any place to hide in terms of protecting equity, protecting asset valuation. And we feel very strongly that those people that don't recognize that and anticipate it and defend themselves against it will lose fortunes because it's, you look at, you mentioned earlier when we were talking about the extent to which inflation has contributed to this. And in historical context, 40 years ago, the last time we had significant inflation under Ronald Reagan and Paul Volcker, or the people that finally came to terms with it, it lasted 8 years. And Reagan, arguably the greatest president in the post-World War II period, and Paul Volcker, the last Fed chairman that really had any balls.
Technical term,
certainly technical term, but men of real vision and steely determination did not blink in the face of 2 recessions and taking interest rates to double-digit levels to finally throttle inflation, get it under control, and catalyze over a quarter of a century worth of growth. And now you have Joe Biden, man who has a tough time staying up on a fat tire bike, and Jerome Powell, whom we have nicknamed the Rubber Lion because he roars, and then as soon as the wind blows against him or in the other direction from Wall Street or the administration, he bends. So you have two men of, we think, little character, little vision, and just aren't up to it. And so the idea that we're going to get out of this without any pain, significant pain from a recessionary standpoint, we think is wishful thinking. And so you really, really do need to be prepared for this and invest as defensively as you possibly can. And, as a natural segue into DSTs, that's what the DST property ownership format allows you to do most easily because of the fractional nature of ownership, is go from having a single asset in one place, providing one function, and diversify both functionally and geographically over many different places. And so I think you're going to find in this kind of storm is being as diversified as you possibly can be from an ownership standpoint.
So just for context, this we are speaking to you, this is mid-August of 2022, sort of keep things in context. So you don't look at this in 5 years and say, okay, they're going to look at this in 5 years and say, he was totally right?
Hopefully.
Yes. So yeah, I guess back to that diversification thing. That's something we deal with a lot with the retirement side of our businesses. Is somebody will say, well, gee, why do you want to self-direct an IRA 401k? And people come to us, they want to do that. They want to go out and buy real estate, make loans, buy notes, buy whatever. I mean, our accounts allow people to buy crypto even. But ultimately, any financial advisor, you made the comment earlier, is diversification. So why not do it? And that's why people come to us with the retirement accounts, is to further diversify. And if you look at, for example, the amount of retirement money in Wall Street, it's just a minuscule, or not retirement money in Wall Street, the retirement money that is in real estate is just minuscule. I mean, the percentage, it's like 2%. And so you just look at it from that context, and that's not really diversification. The comment you made about the DSTs, it's so easy for people to diversify, and I don't sell them. I just facilitate the exchanges into them, so I'll be clear, I don't get anything if he buys them for you, anything else. I'm just standing out here. But my perspective of them, it's an amazing way to diversify, not just geographically, but like you said, into different asset types within that whole segment of the economy. I mean, it's so easy to do that. And if I talk to my wife about going to diversify out of the People's Republic of Portland, right, because I have no ownership rights as a property owner here, and I want to go out and buy in Texas or someplace, and Sheila's going to say, well, gee, I really don't want to do that because we're going to have to fly back there and check it out, do all that stuff. And that's the beauty of the DST, is you're not having to go deal with all of that stuff.
No, you're capitalizing on institutional expertise. Many of the DST property syndicators companies are national companies that have owned and managed billions of dollars worth of commercial real estate nationwide, have a nationwide ownership footprint. So you're not the Lone Ranger, like you just said, saying, hey, I'm in the People's Republic of Portland, I've been systematically stripped of my property rights, and it's simply going to get worse, not better. How do I get off? How do I get out of Portland? How do I get off of the left coast? How do I go to a red state where more people, money, and business are still migrating, and take advantage of that? And if you want to go to Texas, you want to go to Florida, you want to go to Tennessee, it's very, very hard to do that by yourself. But as part of an institutional group that already owns and operates properties in those markets, it makes it much easier for you to make that transition out of a market that, quite honestly, is very hostile to property rights and landlord rights, to a market that is not. Because despite the fact that we're at the epicenter of it, being in Portland or being on the West Coast, this isn't the way the entire country operates. There are more normal environments.
There are safe harbors.
There are safe harbors where where property rights are respected and landlords are not vilified.
So let's come back in a couple minutes. We're going to take a quick break. Don't go away. We're going to talk a little bit more about safe harbors. We're going to talk a little bit more about softer landings when the bubble pops, and just ways to protect it. And I'd like to talk a little bit about, once again, real estate being the ultimate tangible asset. And anyway, don't go away. We'll be right back. David Moore, Equity Advantage, and Robert Smith, Peregrine Private Capital. Thank you.